Stop. Before you click on another video titled Top 5 Mutual Funds for 2025, I want you to ask yourself a question. If those videos were right last year, why are you still searching for the best funds this year? The thing is, you're stuck in an endless loop. You're watching multiple videos, they all have conflicting advice, and you're more confused now than when you started. You're afraid that one wrong choice could set your financial goals back by years. I know exactly how that feels because I've been there too. I'm Vikas, I'm 25, and this is my actual portfolio worth 50 lakh rupees. I'm going to show you the exact 3 fund strategy that got me here and why you'll never need to watch another top funds for 2025 or 2026 video ever again. Before we start, if this sounds helpful, hit that like button. I'm building this channel to document my journey to 1 crore by end of 2027, and your support helps me create more content like this. The biggest mistake that most people make is picking funds based on last year's performance. It's like choosing a cricket team based on who scored the most runs in yesterday's match, totally ignoring that today you're playing on a completely different pitch. Instead of chasing last year's winners, smart investors focus on something called factors. Don't worry, I'll explain this in simple terms. A factor is basically an investment style or an approach. Think of it like different types of players in cricket. Some batsmen are defensive and some are aggressive. They go for big shots and all the fun stuff, right? And others are all rounders having a balanced approach. In mutual funds, we have similar styles. Value funds are defensive. They buy good companies when they are cheap. And we also have growth funds, which are aggressive. They buy companies that are growing fast. And there is also momentum. Momentum funds are opportunistic. They buy whatever is trending up. Now, why does this matter? Different investment styles perform well in different times. When the market is falling, value funds, the defensive one, typically fall less. When the market is booming, growth and momentum funds typically give higher returns. Studies show that value and momentum have a negative correlation of minus 0.48, while quality has low correlation with both 0.36 with momentum and minus 0.05 with value. By combining funds with low correlation and negative correlation, you basically create a diversified portfolio. You're building a team that can perform well in different market conditions. Let me show this to you on my Excel sheet. Think of it as a simple grid. The 3 rows represent the investment factors we just discussed: value, growth, and momentum. And the 3 columns represent the size of the companies the funds invest in. That's large cap, mid cap, and small cap. And here our goal is simple: to pick one great fund for each of these categories. This gives us a diversified factor-based portfolio of just 3 to 4 mutual funds. First up, we have value. Value investing is about buying great companies at a discount. Something like buying HDFC Bank at a PB of 2.5 or buying TCS at a PE of 25. It's like buying a branded t-shirt at 40% off during a sale. Because you're buying it for less than its median valuation, your downside risk is also lower. This is a defensive player. Where do we place it? Large, mid, or small cap? For value, I prefer the stability of large cap companies, but pure large cap funds in India have a problem. SEBI regulations require them to invest at least 80% in the top 100 stocks, which gives the fund manager very little room to outperform the Nifty 50 index. At which point, it's probably better to just buy the Nifty 50 index ETF. So instead of a large cap fund, let's go with a flexi cap fund in this box. It gives the fund manager the freedom to invest across the Nifty 500 universe. My choice here is, drum rolls, yes, you guessed it right. It's the Parag Parikh Flexi Cap Fund. Why this fund? It has a strong value-oriented philosophy. I have been investing in this fund since COVID, and they used to have a good amount of allocation to US tech stocks like Google, Microsoft, and Amazon, giving you global diversification that most other funds do not offer. Although this has been put on hold for quite some time now, and if you want to have a passive fund in this box, just get a low-cost Nifty 500 index fund and you will be good. Up next, we have growth as a factor. Growth investing is about buying companies that are expected to grow faster than the overall market. These are your star batsmen who can consistently hit those boundaries. And for the growth factor in India, one category has been the undisputed champion for the last decade, and it's the Nifty Midcap 150 index. This index has significantly outperformed both large and small caps over the longer run. This is why I like to build my growth allocation around the mid cap space. In this category, I prefer an active fund because a good fund manager has a real shot at beating the index. We can look into something like Motilal Oswal Mid Cap Fund. Why Motilal Oswal Fund? This fund is more of a focused and concentrated fund with 80% allocation in top 20 holdings. Usually, mutual funds hold 50 to 100 stocks, and this concentration helps in improving the chances of outperforming the benchmark index. They follow a disciplined QGLP framework that falls for quality, growth, longevity, and price, which I also personally align with. It has consistently been a top percentile performer in its category. You can also look into something like an HDFC or a SBI mid cap fund. As for the momentum side of things, it is quite simple. You buy what's already going up. The trend is your friend. This is an aggressive strategy which is often cyclical. It can give you great returns at good times but can also fall significantly in bad times, and it works best in a strong bull market. Because this is a high risk, high reward strategy, I pair it with the small cap category. Now, for the fund itself, my choice here is the Quant Small Cap Fund. This fund had a phenomenal run, but its performance has been average in the last couple of quarters. So, why is it still in my framework? Like I said initially, it's not about the top performing fund for a certain year or a quarter. It's about the framework that the fund house follows, and my bet is on the fund house's unique quant based investing system for the long term. And about 25% of my mutual fund money goes here. Again, this is just my opinion and I can be wrong about it, only time can tell. And I'm not giving you any investment or financial advice, I'm just sharing the framework that I am using, and all of this is for educational purposes. Feel free to pick and choose any fund you want under any of these metrics, because end of the day it's your money and only you are responsible for it. So if you want to take a safer bet, you can go with an index fund as well. UTI and Mirai Asset offer momentum funds. Their names are very long, I will add it somewhere here. You can check them out too. Alright, so you have a practical framework that you can apply to your investing goals. But how do you implement this strategy? Decide your total investment amount. Let's say you want to invest 10,000 rupees per month. Split it based on your risk appetite. I use an aggressive 40% in large cap, 35% in mid cap, and 25% in small cap split, because at 25 my time horizon is long and my risk tolerance is also high. If you're more conservative, you might flip that to having 60% in the large cap value kind of funds. I also keep investing lump sum as and when there's a 10 to 15% correction. You can buy these funds through any of the SEBI registered brokers, and please make sure to always buy a direct mutual fund and not a regular mutual fund. You don't want to be paying those extra commissions. Now, I want you to do some homework. Research these funds yourself. Don't just take my word for it. Look up these funds on Value Research Online or Morningstar. Assess your risk tolerance. If you can't handle seeing your portfolio drop by 20 or 30% in a bad year, reduce the allocation from small and mid cap funds. Start small. Begin with whatever amount you're comfortable with. Even if it is just 5,000 rupees per month, set up automatic investments. The key to this strategy working is consistency, not timing the market. You can even expand on this framework by including a gold fund or an US based equity fund. But don't over diversify, as it can cost you big in the longer run. Stick to 3-4 mutual funds, and these portfolios are already diversified. You don't have to keep diversifying more and end up buying the entire market. I've just shared my entire mutual fund playbook with you for free. All I ask in return is for you to start your journey. Remember, it's important for you to start your journey than to keep optimizing for returns. This is an endless pursuit, and top performing funds change every year. Don't worry too much if your fund is in the top 3 or not. What matters more is whether or not you're able to increase your SIPs over the years or not. Alright, so that was the video, guys. I hope you learned a new way of looking at building your mutual fund portfolio. The goal of this video was to give you a framework to build on and not take any of these as recommendations. Also, let me know in the comments if you have invested in any of these funds and what has been your performance like. If you have come this far in the video, I would like you to subscribe to the channel, as that motivates me to make more such videos. Thanks for watching. Bye.